Hello, greetings of the day. This is Professor Ramakrishna. Welcome to my YouTube channel Archiversity. Using this YouTube channel and also with my website, that is archiversity.com, I share my knowledge in various subjects of finance, accounting, as well as statistics and software applications like Microsoft Excel, SPSS, eViews to the students, practitioners, small business owners spread across the world. The topic that I am going to discuss in this lecture is how to generalize transactions in accrual accounting. So as you know, by this time, accounting has a two basis. One is a cash basis of accounting and second one is a accrual basis of accounting. So in cash basis of accounting, we record only transactions for which we received or paid cash. Whereas the accrual basis of accounting is based on three important accounting principles. One is your accounting period, then revenue recognition, and the third one is a matching. That means all the revenues which are pertaining to a particular fiscal year or a financial year need to be recognized during that year only. In addition to that, all the expenditure or expenses that we incur to earn that revenues during that financial year need to be accounted during that financial year or fiscal year. So these two are important principles or important concepts of accounting, which helps you to enter or generalize the transactions in books of journals or books of original entry using a accrual accounting. I'll explain this with a certain examples. So pay key attention in understanding this, because many a times students find difficulty in recording in recording transactions, especially related to the accrual accounting. So for below transactions, assume the calendar year as a fiscal year, that is January 1st, 2021 to December 31st. This is your fiscal year or a financial year, or you can say the accounting year. So consider the accounting year as January 1st to December 31st. Next is generalize the transactions on the day of occurrence and on the last working day of the fiscal year. So last working day of the fiscal year is December 31st. So three accounting principles which guide us or which help us in recording these accrual accounting are: one is a accounting period. So here we are saying that the accounting period, that is your fiscal year, is from Jan 1st to December 31st. So all the transactions during this period is to be recorded. Then the revenue should be recorded or recognized which is earned during this period. That is a revenue recognition concept. And third one is the matching concept, which says that all the expenditure incurred to generate revenues during this particular period need to be recorded. So these are the three accounting principles. Now we look at the first transaction. That is, on Jan 1st, Babu paid rupees 4,800 for an insurance policy for the next 2 years. So the insurance policy is paid for 2 years. So in the first instance, that is on Jan 1st, one is your prepaid insurance, because you paid an insurance for the coming 2 years, and second one is your cash. So prepaid insurance is an asset, cash is also an asset. So prepaid insurance, there is increase. Now there is assuming that there is no insurance at all. Now you have a prepaid insurance worth of 4,800. So there is an increase in your asset, and you are making this, or you bought this by paying a cash. So cash, there is a decrease in a cash. Now increase in asset is debit and decrease in asset is a credit. So first what is that we do is, on Jan 1st, we journalize this transaction as prepaid insurance account debtor to cash account. So what is the amount we paid? 4,800 and 4,800. We will write a narration for this saying that insurance premium paid for next 2 years. Now this is the first entry. Now next is that, as we are saying, that accrual accounting needs to match the expenditure related to particular year's revenue only. So that means of the 4,800 paid, this is for the 2 years, and for the current year how much it will be? So you have a 4,800, this is for a 2 years, so divided by 2, 2,400 is per year. Now as we are supposed to write the transactions both on the day of occurrence, we wrote here, and on the last working day of the fiscal year, that is the December 31st. So on December 31st, what is that we do is December 31st 2021. Now of the 4,800 prepaid insurance, we consumed or we utilized 2,400 rupees for the current year. So your insurance expense is 1, then your prepaid insurance is another account. So insurance expenditure, this is an expenditure, and prepaid insurance is an asset. Now what is happening to your asset? The value of asset is decreasing and there is an increase in your expenditure. So when the asset decreases, we'll credit, and when expenditure increases, we debit this account. So on December 31st, what is it we do is insurance expenditure account debtor to prepaid insurance. And what is the amount for this particular year? 2,400. So we'll write a 2,400 here and 2,400 here. Now we'll write a narration, that is insurance amount for the current fiscal year. So charge it to profit and loss account, or simply we say that this. That means now your prepaid insurance will be only 2,400. That is, your asset will be only 2,400 and expenditure is 2,400. Total is 4,800. So this is how we have to make adjustment for our expenses incurred along to in accordance to the accrual basis of accounting. Now next, coming to the next transaction. On January 1st, Babu buys new furniture for which he pays rupees 50,000. Expected life of this furniture is 5 years with rupees 10,000 as a scrap value. So on January 1st, our transaction would be very simple because you purchased the furniture and paid cash. So furniture is an asset, cash is an asset. Furniture, there is an increase, cash, there is a decrease. Increase in your asset is a debit and decrease in your asset is a credit. So we'll write like a transaction is furniture account debtor to cash account and the amount is 50,000. So, and your narration will be being furniture purchased for office use. Now this is on the Jan 1st. Now on on December 31st, you have to write another entry because this furniture which you bought for 50,000 rupees is having an expected life of a 5 years. That means you are using this furniture for 5 years. But from this 50,000, how much of the amount that you use it for this particular year, that we call as a depreciation. Now how is it we are going to get our depreciation is value of the asset, that is 50,000, minus scrap value, that is 10,000 is the scrap value. Here we have a scrap value 10,000 and value of the asset is 50,000 upon expected life. Expected life is 5 years. So this comes 40,000 upon 5. This equals to 8,000. So your depreciation, that is the amount of expenditure to be charged during this year, is 8,000. So here what are the two accounts that you have? One is a depreciation, that is depreciation is an expenditure, and then you will have this accumulated depreciation account, because depreciation is not going out from your business, so it will be transferred from your depreciation to the accumulated depreciation account. So depreciation expenditure is an expense and accumulated depreciation is a liability. And here increase in expenditure, increase in a liability. When your expenses increase, we debit, and when your liabilities increase, we credit. So our journal entry on December 31st will be on December 31st. So depreciation account debtor to accumulated depreciation account. So amount is 8,000 and 8,000. Now here what is that we write is narration is depreciation provided on furniture for the current fiscal year. Next, on December 31st, Babu received rupees 50,000 and agreed to provide services in 2 months. In December, Babu provided service worth rupees 30,000. So here on 1st December, what is that you are doing? You are receiving an advance, that is your unearned income. So this income is not yet earned, you simply received as an advance. Technically we call this as unearned income, and for the services that you are supposed to be provided. So, and what is that you are receiving? You have received a cash. So unearned income is your liability, cash is an asset. So there is an increase in asset and also increase in your liability. So increase in your asset is debit and increase in your liability is credit. So on December 1st, the entry that is in your books of journal is cash account debtor to unearned income. So the amount is rupees 50,000. Now here narration what we write is received advance for the services to be provided. Now next is on the closing day, that is on December 31st. In December, Babu provided service worth rupees 30,000. So that means from these advances, now you are receiving a revenue. So one is your revenue and the second one is your unearned income. So that is a revenue is your sale, or we say this is a revenue, and unearned income is your liability. There is an increase in revenue and decrease in your liability. So increase in revenue is credit and decrease in your liability is debit. So the transaction on December 31st will be on December 31st, unearned income, that is you make an adjustment for this of rupees 30,000 to sales is rupees 30,000. So adjusted the sales amount from advance amount received. Now what will happen to your liability now? Instead of unearned income now, initially it was 50,000 and from that you are deducting 20. So your unearned income, that is a liability, will be 20,000. So this is another transaction. Next is Babu pays salaries to his staff on the first working day of the following month. So salaries for the month of December is rupees 15,000. Now when this salary for the month of December is paid on a first working day of the following, that is a Jan 1st. But our fiscal year is closing on a December 31st. So we have to write an entry. One is that your salaries to be paid, that is your outstanding salaries. This is one. And next one is your salaries. So outstanding salaries is a liability, salaries is an expenditure. Now what is happening to your liability? There is an increase in liability and there is an increase in your expenditure. So increase in a liability is your credit and increase in your expenditure is a debit. So the entry, that is a general transaction, will be on December 31st. So which account we have to debit? Salaries. Salaries account debtor to outstanding salaries. That means this salary we own to our employees, or this is a liability that we have to clear in a coming month. So the amount is 15,000 and 15,000. So here we the narration is salaries for the month of December to be paid to employees. So that means this salary amount pertaining to the current financial year or a fiscal year, that is the reason why we are showing as an expenditure, and as this is not paid, we are creating a liability and saying that this amount has to be paid. Next one is Babu availed a 12% 3-month rupees 1 lakh limit with his bank on December 1st 2021. Babu will repay the principal and interest on Feb 2022. So first transaction is very clear, that is you are receiving a loan, that is a short-term loan, and second one is your cash. So loan is a liability, cash is an asset. There is an increase in asset and also increase in a liability. So increase in asset is debit, increase in liability is a credit. Now first what is that we do is on December 1st we write a transaction saying that cash account debtor to short term loan and the amount is 1 lakh. And we'll write here that being loan borrowed or availed from bank. Now on December 31st, so we are saying that Babu will repay the principal and interest on February 28, but this loan is for 3 months. However, in the current financial year or fiscal year, that is Jan 1st to December 31st, we have a 1 month here. So during this month there is an accrued interest. So that means 1 lakh is the loan amount that you borrowed for 3 months, and on this you are paying a 12% interest per annum and 1/12, that is for 1 month. So this and this sets off, and this, so your interest amount is 1000 rupees, 1000. That means for the month of December the interest accrued is 1000. So here what happens is two. One is your interest, and second one is your accrued interest. So interest is an expenditure, accrued interest is interest that you have to pay, or we can say that outstanding interest. So this is a liability. There is an increase in a liability, there is an increase in your expenditure. So increase in a liability is credit and increase in expenditure is debit. So on December 31st, our entry will be December 31st. So interest account debtor to accrued interest, or we can say that interest payable. Because this is a payable, you are creating a liability, and the amount is rupees 1000. Now we may be wondering, why is that we have to create this account here? Because according to our matching concept, all the expenditure pertaining to that particular financial year or fiscal year or for that accounting period should be shown in that year only. So 3 months is December, Jan and Feb, and Jan and Feb belongs to the next fiscal year. So we are not considering interest on those 2 months. We are considering only interest on the December month, which is accrued. And as here we says that we'll repay the principal and interest in Feb. So now as we are not paying any interest, that is the reason why we are showing this as an accrued interest or interest amount payable. Next is that on December 1st, 2021, Babu lent a warehouse space to a tenant and allows the tenant to pay rent of rupees 10,000 anytime within the first 10 days of the following month. That means December 1st, that is the rent belongs to the December, will be paid in the month of Jan, that is the next fiscal year. So but for our accounting purpose, the revenue we recognize as received or yet to be received. So one is your rent receivable, and second one is the rent. So rent receivable is an asset because you have to receive a rent, and rent is an expenditure. So here there is an increase in your asset, and the rent, that is here rent is income you are receiving, you let the amount, so is a income, or we can say that revenue. So there is an increase in a revenue. So rent receivable, asset, increase, debit, rent, that is a income, your revenue, increase, and this is a credit. So on December 31st, our journal entry will be, which account we have to debit? Rent receivable. So rent receivable account debtor to rental income. Why we are writing, I am writing a rental income is When we say the rent, we consider this as an expenditure. So to avoid that, I'm writing a rental income, and the amount is rupees 10,000. And in the narration, we write that rent amount of rupees 10,000 yet to be received from the tenant. So this is a narration. Why we are writing this is because according to our accrual, revenue need to be recognized during that financial year only, whether we receive or we not. So in this case, we have not received the cash. So that is the reason why we created an asset, that is a rent receivable. So this is how you have to create, or you have to write journal entries considering the accrual accounting. And while writing journal entries in accrual accounting, you have to pay attention towards the three basic principles of accounting. One is, that is accounting period, then revenue recognition, and the matching concept. Using these three principles, you have to write. And once you understand, get familiar with these three accounting principles, writing journal entries for accrual accounting is damn easy. So hope this lecture will help you to understand how to write or how to journalize the transactions in accrual accounting. With this lecture, this is a fourth lecture in the series of journal entries. I'll conclude the journal entries. In my next lecture, I'll move to explain you on how to write or how to post transactions from journal to a ledger. We simply call it as a ledger posting. Thank you for watching the lecture. Keep watching and enhance your knowledge in financial accounting. See you soon.